Hey, what's good, fam? This your boy Royalty Trades. It's been a minute, man, since I made any type of videos. I just been kind of focused in on a few other things having to do with the kingdom trading, and just kind of been losing track of a lot of my time shooting videos or whatnot. But we're back. Somebody requested a video on moving averages, my take on moving averages. So um, I'm just gonna tap in for a few minutes, give you my pros and my cons of how I feel about moving averages, which ones I use, EMA versus SMA, and honestly, I don't use them much. I did my time, my few years of using EMAs and SMAs. Are they needed? They help. Just like any other indicator, they're good with finding confluences to justify direction or um, due diligence that you're looking for in a particular stock. But the market that we're in right now, with it being so choppy, so much sideways movement, I wouldn't personally rely on them right now. There's so many other factors that play into it. But for the most part, it can be helpful if you definitely know what you're looking at. If you're learning how to read between different time frames and how to apply them, they definitely can be a help if used right. So, first and foremost, everything I'm doing is for entertainment purposes. I'm just sharing my due diligence and what I've learned over the past few years in trading. I'm just sharing it with you guys. So if you're a trader, an investor, definitely do your own research, due diligence, and do your homework before putting your money into it. You work too hard to get it. I wouldn't want you guys to throw it away. You feel me? So um, I'm just a dude that loves to trade charts, not a financial advisor. So, anyways, I got the moving averages up. You feel me? Chart that I got up right now is SoundHorn AI. This was one of the charts that I was given to take a look at on after hours. If you're on there, shout out to you. Right now, as far as the moving average that I have set up right now is set up to the SMAs, and the ones that I choose are the 21, 34, 50, 200. And the reason why I choose those particular ones are because the higher the higher the moving average, the less it reacts to volatility. So each one is going to give me a clear and defined moving average, and it kind of helps based off the volatility. So 21 for me works alongside the 34, and that's to show me which direction a trend is being carried. So price action normally likes to bounce off the 21 and the 34 and hold on those trend levels if it's a healthy trending stock in a particular direction. Of course, the 50 MA is what I like to use to track the momentum, whether it's bullish or bearish. If it's above the 50, I'm considering a bullish uptrend. If it's below its 50, I'm considering a bearish downtrend. And then of course you have the 200, my favorite one because it overall carries the hard rejection or the solid support on price action. So personal colors: blue, green means go, orange, or this little yellow, whichever one, orange. That's pretty much for me is a cautionary, which side of the fence is the price action on, with the 50, and then the red 200. That's just like red light, hard support, hard rejection on price action. You can also add the 100, and I used to use that for like a yellow. We're approaching the 200, but for the most part, I like to keep my charts as clean as possible. So I don't want to add too many lines on there, too many colors, just to be able to kind of make, more of a clean judgment on price action when I'm looking at the charts. So that's my preferred setup as far as SMAs. Same thing for EMAs. The difference between the SMA and the EMA, the SMA moves a lot slower. It's a lot more, less reactive to volatility. You feel me? So if I'm looking at the EMAs are more reactive. So if we go to the EMAs, you can see they're now placed in different areas, because EMAs, exponential moving averages, they're more reactive to a stock's price action and volatility, so they'll line up a little bit different. But for the most part, I used to use EMAs a lot until we got into a choppy market. Now I like to look at the SMAs, and like you said, like I told you, they end up lining up in a different way. So, all right, down to using them on the actual charts. All right, so like I said, right now we got ticker symbol sound up, SoundHorn AI. So if we're looking at a bigger picture, we do have some highs up here. We have a little bit area of consolidation here before it gapped down and it traded all the way back down to what I said the 200 is. Normally 200 is solid support. Alright, so you see a bounce here, and then you see a brief period right here to where it trades below the 200 SMA. Once it comes back above, it's used as a support here to actually build and trade its way back up to the upside, and here we are back below 200. So this is my thing and how I like to use it. If you like a company, along with having some more trend lines or RSI or anything that you like to use, for me, for instance, I like price action. So before I even start looking at these, I'm looking at consolidated areas, and you probably see some of this in my older videos if you've been following my my TA lessons for a little minute. So I see this little area consolidation here. We see price action briefly tested this area as it traded below the 200, and this is on a daily time frame. All right, so for me, if it's a company that you really fuck with, once it trades below the 200 moving average on a daily, you want to go and you want to find the next area of support, and this would be your area to start buying the dip. Obviously, you can buy it above the 200, but if you really want to step into deep DCA on a company that you like, that you believe in, anything below the 200 moving averages is considered a sell to me. All right. So if you would have bought this below the 200 and you use some more TA and you caught another support level, once it dipped into this box right here, or once it came below the 200, you're buying the dip. Whether it's shares, whether it's long dated contracts, you're buying the dip on the move back up above the 200. And then once you get back above the 200 EMA, then you're seeing that, all right, price action is, let me do this real quick. Yep. All right, so let's take off all the rest. Let's look at only the 200. Because if you really want to dissect, you need to really understand how each one works. You feel me? So once it came below this 200 MA, you buy the dip, you catch it back above here, uses it as support for the move back up. Now obviously you got a gap down right here. Here's where you got bears sitting at. Any gap down levels are considered to be bearish. So here you are, you got it above the 200, where it's back above the 200, you catch the pop back up. Here's bearish territory, you sell, you catch it back down on the 200, you do the same thing, you recycle your profits to do the same thing over and over. If it dips back below the 200, then obviously this is sell territory, back down to your support levels. You're waiting for the move back up in here where you should be deep in profits if you DCA below the 200 on the move back to the upside. You feel me? So this is just one way to use the 200 SMA, which is, like I said, is one of my favorites. But when you start adding more moving averages, you have to learn how to read them more and more, apparently. So let's get rid of some of these boxes. I'm even gonna get rid of this little triangle pattern just to break it down more. So, all right. What we're starting to see right now with these moving averages is you're starting to see all the different averages starting to squeeze together and come together tighter. So this can be an indication of choppier price action. This could be an indication that price action is waiting on particular news, a catalyst, or anything, and we'll start to see the prices start to tighten. So right now, everything is starting to come together in this area right here. If we had Bollinger Bands up or something, you'll start to see the Bollinger Bands start to tighten here and squeeze, and you'll wait for the release, and then you will trade the release of the Bollinger Bands, which that'll coincide with a rollover or a curl up of your moving averages. Okay, so once you see the price action get within here, this is be your no man's land. Okay, now you do check higher time frames to see where they're at, because every time you change time frames, different time frames are gonna have the actual moving averages in different positions. So this is where you have to learn how to read multiple time frames with different levels of moving averages. So this one doesn't have the 200 in there. If I threw if I added this into an EMA, it'll probably show up. Nope. So on this particular chart, it just hasn't painted a 200 moving average yet. It has the 21, the 34, and the 50, and right now prices are trading above the 50. Like I said, the 50 is an indicator of which side of the trend is on. So it's above the 50, we can expect, you know, some momentum to the upside. If it's below, we can expect the momentum to the downside, carried or rejecting the 34 and the 21. So on the weekly, is trading a little bit above the 50. This weekly candle closed bullishly, but the prior candle here is a big bullish engulfing candle. So that means until these highs are taken out, and these lows right here, this is where your chop zone is going to be based off of this candle right here, just because it took out the previous week's bulls on both directions. So this would be another reason why we're going to start to see these bands start to tighten and trade sideways too. All right, and as you can see, that previous candles, this is where we're seeing the prices hang out. So we need a catalyst. Right now, the moving averages aren't going to tell us what exactly we need to be looking for. All right. So now that we're here, we can see two things. We can see price break below here, below this $9, and start to trade further down, which will result in what you see, a declining moving average crossover. So once you see price action here, you will see these moving averages start to cross over. This 50 is below the 50, so we're seeing a bearish trend. and these crossovers start to come below, and these will start reacting as rejection spots for price action. So last time that we saw a bearish crossover on moving averages, it starts to happen right up in here. So we see the 21 already came down and crossed over the 50. Later on, it traded back above, but then we seen the 34 start to trade back down, and this whole area right here starts to become bearish rejection areas, and you'll start to look for the move down towards the 200. So once these start to carry over, anytime it comes back up, and retests a trend. Since the 50 is the stronger one and is trading at the highest level, it needs to get back above the 50 in order to trade to a bullish level. So right now we're rejecting at the 21, rejecting in between the 34, and it's trading back down. So now that we see how a bearish crossover affects the price action, now you want to look at what happens when you see the crossover start to go back to the upside in a bullish way. So once again, once you see the price action back above the 200, the 200 starts to be your foundation for price action. Once you see the price action starts to handle itself pretty well, you will catch the other actual moving averages start to come and curl itself back over. So this is a bullish crossover back using the moving averages. It held the 200, and then you get the help of the 34 and the 21 starts to curl back up, and this is where you see the cross hit right there. So normally when you see that cross, the price action is playing itself out, and this is what initiates the cross to give you more confirmation that, all right, we're heading to the upside. So once we get that cross here, you're already seeing the price action is already actually starting to spike itself up, and the cross happens later around this candle right here. Now, what happened? It crossed all the way up into a supply zone, rejected, and it came back down by the time the actual EMA crosses were all the way finished playing itself out. So this is what moving averages get a bit, what's the word? False breakouts, false breakdowns, cause choppiness in the price action, because you can't hold too long, because we're not actually in a trending market overall. So this is where you have to use different confluences in order to see, which crossovers are going to be the most dominant or truest crossovers. So like I said, right now we're trading below the 200 on a daily. We're trading right at the 50. We're seeing consolidation between $10.50 and $9. This is where the price action is gonna kind of tighten itself up before you see a breakout of either direction. You feel me? So if we break out above this, then we invalidate that weekly candle that we saw right here. We start to invalidate that, and we take out previous highs. Since this is where the bears took over, this is the candle where I want to place heavy emphasis on to break out of, or else we're just going to see a continuation, and the lows that we have here are going to be the continuation for the lows here. We're going to break a support level, and we're going to see a MA crossover here. So this is where you'll see a MA crossover going down there. Now, like I said, all of this is just, is in the air because moving averages are lagging indicators, and they only happen based off of how the price action and the trend is already happening. So that's why it's good to have different type of indicators showing you the sentiment pretty much, or this is where you just learn how to read just candlesticks, price structure, things of that nature, in order to help give you and paint a better picture of what's going on with the candle. So As of right now, we're looking at sound. We're just seeing a tight squeeze here with the moving averages, and we just want to see whether the price action is going to break above here or break below here in order to see which way this moving average crossover is going to happen as we head into the coming days and coming weeks. So that's that one. Let's look at Marvel. I don't think I have anything drawn out for that yet. Cool. Perfect. So let's add gaps. The gaps indicator to make visuals just a little bit better. Alright. So as of right now, what's been happening with Marvel is that it gapped down here based off of earnings. It gapped down. We've been seeing it trade below the 200 since then. It stopped right on the 200 EMA, right on the day of earnings, and it held support. But what happened shortly after that is what? We've already seen the crossover happen all the way up here, and it's been rejecting the 21 ever since. So once it gapped down prior to earnings, it's just been trading sideways, and then we've been getting a slow uptrend right now, which with something like this, you can draw trend lines to kind of help justify the future moves of moving averages. And now that we see a brief breakout, we're trading back into this pressured supply zone, and it's still trading below the 200 EMA. So what you want to use is confirmation. You want to see price action. You want to see this curl right here start to hold up and continue to carry in a direction like this. And then eventually you want to see this 200 EMA and the price action start to meet up, and you want to see prices hold above this 200 EMA. So it's a couple things that you want to see outside of just this. You want to see a gap up, or you want to see something that indicates that buyers are wanting to hold prices above this $85 level. If we look at higher time frames, it's still trading above the 200 SMA on the weekly time frames. Here's one thing that I told you, like we saw on Sound. If you see price action start trading below this 200 moving averages, these are your indications. Hey, I can start a DCA right here, and I can start funneling in some money into this company, because you as an investor or a trader don't believe it's going to be like this forever. So you get the fire discounts below the 200 moving average. You see here we got 10, 11, 12, January, Feb, all the way April. So you had about 6 months here to catch this stock below the 200 moving averages. Once you saw, like a bottom was here, bottom was there, use historical data here to start knowing when to buy. It held up here, I'll buy it here, I'll buy it here, and I catch that move back up, because stocks only go up, right? So you'll catch that move back up, take off, beautiful DCA down here. So you caught that same little price action, very small breach of 200 here on the weekly. Then you got a couple of weeks here to where you were able to DCA down and find a nice dip buy for shares or for longs, either one. And now you're headed back above here to face some, rejection zones here. So it's still below the 50, which is the momentum still on the bearish side, but it's below, above the 200. So simple, you're getting squeeze action here. You're gonna get some squeeze action between these two, the 50 and the 200. So now you're getting back into the neutral zone. Monthly, of course, the monthly looks fire, clearly above the 200 on here. So when you get back to the daily is highlighted based off of the 50 and the 200 on the weekly. So once we go back here, what we watching for? We watching for this area to be bought up in order for us to push out and break to the upside and eventually move our ways above this 200 EMA to build to a higher upside. So these are the indications that we want to see. Arrow here, arrow here. We have the trend here. We want to see that build to the upside, because guess what? If it doesn't, if it exhausts in here, it may have to dip back down in order to find more buyers back down here. So right now I'm just using a lot of different styles of technical analysis to build a picture, you feel me, for me to follow. And I know what to look for. I know why I wanted to do that. And I'm using the moving averages to help paint that picture of a curl to the upside, a hold in this trend here, and I eventually want to see prices back above the 200 EMA on a daily, or SMA on a daily, in order to build the same way the price action melted to the downside here. Once it gets back above the 200 EMA, I want to see the price action melt back to the upside the same way it did here, back to like that 112 area. If it doesn't, we drop back here to this 63 zone. The pattern is invalidated. You might see a sideways movement or a rollover back to the downside, because we never breached that 200 SMA on the daily chart in order to confirm that we want more bullishness. You feel me? So this is how you want to use moving averages. This shouldn't be your only option of trading, but it just should be a help to help you guide in the direction that you want. So I'm gonna look at this one, and then I think this would be enough just to kind of give everybody a general overall view of what to look for. Right now you got a beautiful hold above the 200, and it's been carrying. Like I said, if you like a company, anything below the 200 moving average, snatch it up. Wait for the wait for the return back above the 200. In this case, it didn't hold long. Tested it, got bought back up. It's been trading above it ever since. You have a nice confirmation of a SMA crossover here, and it carrying right now. This is a beautiful display of what I was saying, the 21 and the 34 carries the trend. You feel me? Here you are with the 50. The 50's carrying, so the trend stays intact. Sentiment stays pointing up because the 50's there. Then you're getting a retest of the 21 and the 34. 21, it would be your first level that you would look for a bounce. 34 would be the second one that you would look for a bounce back up to the upside. And you got it. You got a retest of the 34. Price action carried itself back up to the upside, and it wants to retest the highs of this candle right here. Even if it was to break down a little bit more and retest the 50, it's still above the bullish trend of the 50. So you'll take another entry on a bounce looking for a retest. So sometimes when you want to average in 1 contract, 2 contract, 3 contracts, once you retest this, trim one, you get back up here, trim another one, you have a run of the hold back to the upside. Guess what would be your stop loss? Stop loss would be below the 50 moving average. Once it breaks below here, you cut it, because now you're looking at a sideways movement. Once it breaks below the 50, you're looking at it to go sideways. B, you might see price action starts to roll over. And when it rolls over, what you finna do? You finna see it retest the 200 moving average. So then you will start your position over. You will buy here at the 200, and you will look for a move back up. The only way that you will look to cut it is if you just completely see price action rejecting. Instead of it bouncing here, you'll start to see prices start to trade back up and reject it for the move back down. That's your confirmation. You see it break the 200, you look for the retest of the 200, and if it rejects, it comes back down, and that's where you start to see prices roll over. You start to see prices roll over and head back down to where you eventually see these moving averages, roll over to the downside and prices start trading below the 200 EMA. But as long as we're trading above it, you're good. You're solid. It's gonna hold. This just gives you confirmation on the direction that it's headed. Each moving average is gonna give you a story. This is an uptrend. This is a bounce to the uptrend. This is the sentiment to the uptrend. This is the support for the uptrend. And you just paint out the picture. You understand how these move. You understand how price action works. Bigger price action. You go to the weekly. You take all of this off. This just gives you more confluence, because that 200 that I drew out right here, that 200, if you go to the weekly charts, it follows out with the 50 here, which is what? A trend indicator. Above the 50, bullish trend. Prices reach the 200. Let me see. Prices hit 200 here. Highlight it just so you can know. You go back to the weekly, what? That same 200 retest on the daily was a 50 retest on the weekly. See how the different moving averages correlates on different time frames. A solid 200 on the daily is a solid 50 on the weekly. And that retest gave you confirmation to make the move back to the upside. Yeah, it rejected a little bit on a weekly 21 moving average, but guess what? The 34 came and carried it back to the upside. Now we're trading above all 4 moving averages. So it's simple. It's simple. You just break the shit down in a way to where you know how the mechanics of it is working, and then you carry it on like that. You feel me? 50, 200. Those are gonna be your trend sentiment indicators. That's what's gonna carry, let you know which side of it you want to be trading on. And then your 21 and your 34 are gonna be what carries the price action, carries the candles. The bigger the time frame, the more solid the price action is gonna be as far as respecting it. And then you can find different indicators. So a 200 on here is a 50 on the weekly. Those are both strong confluences to let you know it's a strong possibility it's going to be a bounce there. And if we was on the other side of the shit, guess what? It's going, if it rejects here, if it rejects on a 200 on the daily, guess what? It's rejecting the 50 on the weekly. So if you want to use moving averages, definitely use the daily, use the weekly, use the monthly if you have to. And then everything below the daily is going to respect it also. Map your moves out on the daily time frames and higher, because that's what's going to show you strength. And then you'll go ahead and you'll just play it down to the T when you start breaking it down and seeing how everything is respected. You see a crossover right here. That lets you know it's getting ready to continue to move to the upside. You have some carrying support here. And it's a beautiful move. The crossover don't necessarily mean it's going to make the move higher right then and there. That just means it's carrying in the uptrend. Consolidation sideways. It's respecting here on the way back up. This is going to give the lagging indicators time to roll itself back up to the upside. But like I said, a 200 is not affected by all the volatility. If it's going to make a nice little uptrend here, even though this is chopped up and down, sharp decline, guess what? It's still above here. It may level out a little bit more, but the direction is still a slow trend to the upside. So, simple. I just broke down moving averages for you, and I gave you a little way to, go ahead and break that shit down and make a move. So, I'm going to drop this video for y'all on after hours, of course. And if you If you're in the Discord, it'll be in the Kingdom TV channel, of course, for you guys to brush up and use this if you do trade moving averages. So if you watch this 30-minute video all the way through, don't forget to like, don't forget to subscribe. Go ahead and tap in with your boy. I just took a little Saturday since I am off work. It needed to be done. Make this video, drop this video, and hopefully it's give some little insight to new traders. Like I said, I don't really use it, moving averages, but they can be deadly when you know how to use them the right way. I did probably 3 years using moving averages before I was just like, let me see what else I can figure out. Let me go figure out a different way to chart and do this, so that way when I see stuff like this, consolidation periods, I can figure out another way to trade it instead of waiting on this to curl to the upside. So definitely tap in with this strat, master it, make it yours. Until then, once you get it down pat and you can make some money off of it, move on to the next style. That way you have so many different levels of confluences under your belt. You'll never go hungry, you feel me? So it's your boy Royalty Trades, tapping in, moving averages, how to use them. Do I like them? Do I don't? It don't matter. If you can make money, dope with me. Tap in with y'all to the next video. Appreciate y'all for hanging out on this nice little Saturday. Catch y'all in the meantime.